If you own a home and you are thinking about selling it this spring, there is a gap between what you probably believe about this market and what the data actually shows. And that gap is closing fast. Existing home sales just fell 3.6% month over month in March 2026. March is the first month of the spring selling season, and it fell. Every single region of the United States posted a decline. The Northeast, which was supposed to be bulletproof, fell 8.5% month over month. The Midwest, also supposed to be immune, fell 4.2%. The South was down 3.1%. The West was down 1.3%. There is no regional story to hide behind anymore. The slowdown is national. And the seller sentiment data we are about to walk through explains exactly why this is happening and what it means for anyone with a home in this market. Before we get into this, subscribe to Housing Intel if you have not already. The data we are about to cover is moving fast, and the window to act on it is short. Subscribers get every report the moment it drops. Hit subscribe. Now let us look at what is actually happening. Let us start with what sellers believe right now, because the distance between seller expectations and market reality is one of the most consequential dynamics in this housing cycle. According to the most recent seller sentiment survey, 83% of current home sellers expect to receive their asking price or higher. Let that number sit for a moment. Only 12% believe they will sell below asking. Less than 5% say they do not know. Now here is the context that makes those numbers important. In 2025, roughly 90% of listings that went on the market required at least one price cut before they sold. 9 out of 10. That means the sellers who came to market expecting full price last year were almost universally wrong. And yet the sellers entering the market today hold the same expectation at nearly the same rate. There is one nuance worth understanding here. Some of that confidence is not entirely irrational. The survey also shows that more sellers are now pricing their homes closer to realistic values from the start. If you price correctly on day one, you are more likely to get near asking price because you are not asking for something the market will not bear. So a portion of that 83% is sellers who have done their homework. The problem is that a significant portion of the remaining sellers have simply inherited the belief that real estate always finds a way to deliver the number they want, regardless of conditions. The data also shows that 40% of sellers expect they will need to cut their price or offer concessions during this spring market. That is up from 30% at the same point last year, a 10 percentage point increase in 1 year. More sellers are getting the message, but in reality, the share who will actually end up cutting prices once they are on the market will be considerably higher than 40%. The expectation still lags the outcome. Now, let us look at why seller expectations are still elevated despite everything the market has been signaling. This is where it gets analytically interesting. The survey reveals a meaningful shift in why people are choosing to sell right now. 41% of sellers say they are listing specifically to make a profit, up from 36% the year before. Meanwhile, the share selling for lifestyle reasons, changing neighborhoods, right-sizing, that kind of thing, has dropped from 46% to 41%. And 39% are selling because they want more space. The financial motivation is rising. The lifestyle motivation is falling. What this means is that a growing share of sellers are entering the market with a specific return expectation in mind. They have watched their neighbors sell at high prices during the pandemic run-up, or they know what they paid for their home and what they believe it should be worth now, and they are coming to market with a number attached to their decision to sell. That makes them more resistant to price reductions because the reduction is not just about the home. It is about whether the transaction still makes financial sense at all. And here is where that mindset collides with reality. Only 26% of the top 50 metro areas in the United States are currently functioning as sellers' markets. 47% of sellers describe the market as a seller's market. The gap between perception and data is roughly 21 percentage points. That gap is the source of the friction you are seeing across the market. Homes sitting on the market, price cuts coming slowly, sellers pulling listings rather than adjusting. On the question of what sellers will do if their home does not sell in the first month, the data shows some meaningful progress, but also a persistent problem. 35% say they would cut the price. 34% say they would wait it out. 29% say they would pull the listing off the market entirely. The positive reading is that 70% are at least theoretically willing to either reduce the price or keep the home available for offers. That is a more realistic posture than we have seen in prior years. But 29% still say they would pull the listing. These are sellers who have watched the cycle repeat for 2 or 3 years in a row, tried the market, got frustrated, pulled the listing, and came back the following spring believing conditions would be better. In most markets, they were not better. And based on the transaction data we are about to cover, the evidence strongly suggests they will not be materially better in 2026 either. Before we get to the macro sales data, leave a comment below. Are you currently a seller, a buyer, or a homeowner watching this from the sidelines? Tell us which market you are in. We read every comment, and your situation shapes what we cover next. Now, back to the data. The National Association of Realtors released the March Existing Home Sales Report. The headline number: a 3.6% month-over-month decline. Seasonally adjusted annual rate of 3.98 million sales. That is below 4 million. The last 2 years were already the worst sales environments since the early 1990s. If this March pace holds, 2026 will extend that streak. NAR's chief economist cited lower consumer confidence and softer job growth as the primary drivers. Consumer confidence has been tracking at levels consistent with significant economic anxiety. The number of Americans who feel secure enough in their employment and their financial situation to make a 30-year commitment to a mortgage payment is smaller right now than at almost any point in recent memory. And that is not a price problem. You cannot solve that with a price cut. NAR has also revised its full-year 2026 forecast down to 4% sales growth from a previous estimate of 5%. That is still significantly more optimistic than Zillow and Redfin, both of which project essentially flat or negative sales for the year. If we stay at the March pace through the rest of 2026, the annual sales figure will come in below 4 million. That would be a new low for the current cycle. On prices, the national median home price in March was $408,000, up 1.4% year-over-year from $403,000 last March. NAR is projecting home prices will rise 4% for the full year. Looking at the transaction data and the demand environment, that projection requires a very specific and optimistic set of assumptions to hold up. The most likely explanation for continued positive median price readings is composition. More transactions at the high end of the market, fewer at the entry and mid-range. When you have more $800,000 and $1.5 million homes transacting relative to lower price points, the median moves up, even if the value of your specific home has not. The Affordability Index actually supports this reading. The Housing Affordability Index was 113.7 in March. 1 year ago, it was 104.2. Affordability improved in all 4 regions. The Northeast up 4.1%, the Midwest up 5.3%, the South up 10%, and the West up 12.7%. If home values were genuinely rising broadly and uniformly, affordability would be getting worse, not better. The fact that affordability is improving substantially while the median price is nominally rising tells you where the real price movement is happening. It is happening in specific segments. For the broad market, conditions are moving in buyers' favor. Inventory. 1.36 million units for sale, up 3% from February and up 2.3% year over year. The supply side is building while the demand side is contracting. That is not a combination that supports broad price appreciation. Now let us cover the home equity situation, because this is an underreported risk for current homeowners that is starting to get more serious. Home equity line of credit originations jumped 16% year over year. That growth reflects homeowners who have been using their equity as a financial buffer against rising costs. Insurance, property taxes, groceries, everything costs more than it did 3 years ago. And for many homeowners, the equity in their home has been the tool they reach for when the monthly budget stops working. That is understandable. It is also increasingly risky. Here is what is changing in the HELOC market. Non-bank lenders are now requiring mandatory upfront draws on new home equity lines of credit. Instead of the traditional model where you draw funds as needed, these lenders are now requiring borrowers to take 50 to 100% of the approved line immediately at closing. That means you are paying interest on money you may not yet need, starting on day one. Traditional banks are slower to implement this, but the trend is moving in one direction. The reason lenders are doing this is not complicated. Mortgage delinquencies are rising. Home values in a significant number of markets are declining. Lenders have less confidence in the equity values securing these loans, so they are structuring them to generate interest income immediately while the equity is still there. It is a defensive posture. The more critical risk is what happens to existing HELOCs in a market where values continue to fall. This has precedent. In 2008, lenders froze or reduced HELOC credit lines when home values dropped below certain thresholds. Borrowers who had been relying on their HELOC as an accessible credit facility found that access was simply gone, often with no advance warning. In some cases, lenders demanded immediate repayment. Homeowners who could not pay had one option: sell. If you are currently carrying a HELOC or considering opening one, this context matters. The HELOC has been functioning as an emergency fund substitute for a large number of American homeowners. If home values in your market continue to fall, and your lender makes a risk assessment that changes your available credit, what looks like financial flexibility right now could become a forced decision very quickly. So let us bring this together with the full picture. The spring 2026 housing market is not performing the way sellers entered it, expecting it to perform. Existing home sales fell in the first month of the season, in all 4 regions, including the markets that were supposed to be resilient. Sellers still hold an optimism level that the transaction data does not support. 83% expect asking price or better. 90% of last year's listings had to cut. The inventory is building. The demand is not recovering. The affordability data shows that buyers are gaining more purchasing power in real terms, which is a net positive for market health over the medium term. But it also means the price discovery process still has room to run. The homeowners who are positioned well right now are the ones who bought before 2021 and have stayed. They have equity and they have time. The risk is not the market itself. The risk is the carrying cost stack, insurance increases, property tax adjustments, HOA costs, and for anyone holding a HELOC against a property in a declining market, the potential for a lender to change the terms of that facility. Those are the variables to track. For sellers, the data gives you a clear framework. The first 2 to 3 weeks on the market are the highest probability window. Listings that do not generate activity in that window are almost always overpriced relative to where the market actually is. 77% of homes sell below asking. The sellers who are adjusting early and pricing accurately are closing deals. The sellers who are waiting for an offer that justifies their original number are watching the comparables around them get lower every week. For buyers, the conditions continue to move in your direction. Affordability is improving across every region of the country. Inventory is rising. Seller concessions are becoming normalized. You have negotiating leverage that buyers simply did not have in 2021 or 2022. The data does not yet point to a bottom in most markets. But if you find the right property at the right price, the structure of this market gives you tools to make a sound transaction. Housing Intel publishes 3 reports every week: Monday, Wednesday, and Friday. Every one of them is built on verified data, not speculation, not opinion, not real estate industry talking points. Subscribe if you want the full picture, and share this video if someone you care about needs to hear it. We will be back with more.